The US Federal Reserve has cut interest rates by 25 basis points this week. This is the rate at which the banks borrow from each other, and that impacts all your personal loans and mortgages too. Now, the decision comes even as fears of recession and high inflation persist in the country. However, it was taken on the basis of a cooling job market. In the past few months, Fed Chairman Jerome Powell was under immense pressure from Donald Trump to cut interest rates massively. It came down to even Trump firing a Fed governor and replacing her with someone he likes, raising concerns of impact on Fed's independence. Meanwhile, Fed has to do a balancing act. Tariffs have already increased prices, but if rates are cut too soon, inflation will rise further, which is already above the target, and there is no rate cut, then the job market will continue to cool down. And as Powell put it, this is a risk management cut to slow the economy down as much that it cannot increase the risk of recession, but also help the job market. But how does this rate cut impact you and the world? Here's a report.
The U.S. Federal Reserve cut its benchmark interest rate by 25 basis points to a range of 4% to 4.25%. The decision was driven by signs of a softening labor market, including slower job growth, a rising unemployment rate now at 4.3%, and ongoing uncertainty across consumer and business sectors. The vote was nearly unanimous, 11-1, with Governor Stephen Miron advocating for an even deeper 50 basis point cut, and policymakers signaling the possibility of 2 more cuts before the end of the year. However, inflation still slightly above the Fed's 2% target. Policymakers acted to lower borrowing costs and shore up confidence, with Chair Jerome Powell citing downside employment risks as a primary concern. The move aims to support hiring and investment at a time when economic uncertainty and inflationary pressures compete for dominance. Lower rates translate to more affordable loans and mortgages for businesses and consumers, encouraging investment and spending. However, troubling signs remain. The labor market has cooled, inflation persists, and confidence wavers. Experts warn that monetary policy alone may not stave off broader economic weakness if inflation stays high or employment worsens further. The Fed's rate cut pushed gold to a historic global high of $3,707.40. While on India's MCX, gold hit 1,10,666 rupees per 10 grams on September 16th. Market experts for short-term caution suggesting a sell position for both gold and silver, anticipating profit booking over the next 1 or 2 days amid volatility, though the longer-term outlook remains strong for both metals. Market reactions have been mixed. Wall Street's Dow Jones surged over 300 points following the announcement, while the S&P 500 and Nasdaq slipped. U.S. Treasury yields fell, and international markets rallied briefly before stabilizing. In India, equity markets responded positively, especially IT stocks. Infosys, LTI-Mindtree, Wipro, and other major IT players rose up to 3% as U.S. rate cuts improved global demand prospects and made Indian stocks more attractive for foreign investors. Both the Sensex and Nifty 50 opened higher, mirroring a positive global mood. A softer dollar will benefit Indian exporters and could strengthen the rupee, though new risks from currency volatility and capital flows remain.
If you like this video, then like, share and subscribe to ET Now.